Hi, guys. Welcome to the How I Raise It podcast, the show where we get an inside, unfiltered look at how real entrepreneurs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Demetrius Gray of Captain, a startup that advances money to contractors after natural disasters so that people can rebuild their homes faster. We talk about why he decided to wind down his original company instead of pivoting to Captain, how he used Tier 3 VCs to train up his pitch deck for Tier 1 VCs, how he used super founders and VC scouts to get intros to investors, and much more. If you're tuning into this podcast to learn how to raise capital for your business, I've created a super valuable free welcome package for you. It includes a list of 2,500 investors who don't require a warm intro, plus 200 questions that investors are going to ask you. It's really going to help you get ready to raise capital. To get instant access to this, click the link in the first comment. And while you're there, please leave us a nice comment what you like about this episode, about this series in general. We really appreciate that. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Demetrius.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Demetrius Gray of Captain coming to us from Louisville, Kentucky. How's your day going?
It's going well, man. Thanks so much for asking.
We're recording this on July 5th. So what was July 4th celebrations in Louisville like?
Well, I have a farm in Western Kentucky, and we spent the entire weekend there. I've got a newborn baby. And so getting away from the city is always really nice. And so I did my first dad experience of buying the fireworks and lighting and putting on a show.
Oh, wow. Fun. Is it a working farm or like a gentleman's farm or, what is it?
It is 100% gentleman's farm. I am not astute enough to be a farmer. That's hard work. And anymore, it's just recreation, four-wheeler riding and, horseback and that sort of stuff.
Do you have any, it sounds like you have horses. Do you have any livestock or pigs or chickens or anything? Or
Well, my neighbor has a number of bulls that he's trying to build a herd, and so that's always fun. My daughter loves that.
Oh, very interesting. That's cool. I have the fantasy of having a ranch somewhere, but purely it sounds like a lot of work. It's like a great fantasy, but then actually like maintaining it and keeping it active sounds like a massive amount of work. So, good on you. Good on you. Well, very cool. Let's jump into what you're up to. What is Captain?
Well, at the end of the day, Captain is solving and funding the climate emergency. So at our core, what we do is we advance money to contractors throughout the United States after natural disasters that occur so that they can begin repairs sooner on homes for policyholders. And so conventionally, we're known as a factorer. In the old school front, we would say that we purchase receivables, but we do it really basically at a 5% discount and allow for the disaster recovery process to speed up. And then we do the slow business of waiting on insurers or the federal government to pay us back.
Interesting. Very interesting. So let's take a scenario. So another Hurricane Katrina happens or something like that. There's a lot of damaged houses. The homeowner would come to you and apply through you, or is it more they would find the country? Walk us through it.
Well, it can actually occur both ways, which is we call it a room with many doors, meaning that a contractor may show up at your home and say, hey, I have a partnership with Captain, I'm approved, and Captain will front all the money so you don't have to pay any deposit. Or in some cases, consumers say, you know what, I need some help getting through this process. I've just lost my home after a wildfire and I don't know what to do next. And so Captain says, oh, okay, well, we have a huge network of contractors and we have money, right? And so don't spend yours. right? Keep yours in your bank account. We'll front all the money, and then you'll pay us back.
Got it. Interesting. Very interesting. And so this is fascinating. And I'm kind of surprised you can do that for a 5% discount, or buying the basically the receivables on a 5% discount, because it seems like there could be quite a long time frame. I guess you've run the numbers, I'm sure, and made it work. But like, is that I would guess it would be a much deeper discount that you're buying the receivables at. Like, how does 5% work?
Well, the unique thing is to think about like repairs in the context of individual trades. Most trades in any building construction project don't take over 30 days, right? And so we charge 5% per trade, right? And so if your framing takes, 2 weeks, if your roof takes 3 days, all of those sort of things incrementally take time. But we're able to do that because we can move the project quickly, because everybody, first of all, knows that they're going to be paid, right? It's so funny how when you align the incentives, people will begin to, snap to it and get to work, right? That's the biggest challenge in this overall climate emergency, beyond simply, people's willingness to do. It's sometimes that the incentives aren't aligned for them to do something well. So meaning that a solar system still costs a lot of money.
Yeah.
Still costs more than putting on that same asphalt shingle roof, right? And in the same way, it's still easier to ask a consumer to pay a deposit before you begin repairs after a hurricane, right? And so what Captain is here to say is that, look, that's not the best way to do this. And there's frankly a lot of risk to the consumer when they pay a contractor something up front, right? And so we're willing to take that risk so that we ensure that things move quickly and efficiently. And ultimately, the insurer or the government benefits because things are moving faster, right? Nothing worse as a mayor or a government official to see an entire community dilapidated. We all know what happened after Hurricane Katrina, right? I mean, it's still not fully recovered. So same thing is true for an insurer. If you're in the state of Florida, you've probably heard a lot about the collapse of their insurance market, or in California after the wildfires. And that's all because they can't control costs, because sometimes these things can go on for years. And years means expensive. So Captain sort of says, okay, let's get with it. Let's actually do what we need to do and get done.
It's interesting. I was going to ask my next question, kind of like, I like the aligning incentives part. It seems like insurance companies would still take a long time to pay out, but I guess the incentive there is, as you're starting to touch on there, speeding things up can reduce their costs. So maybe they won't be dragging their feet for 6 months to pay out. Is that kind of a layman's summary of that?
That's exactly right. And what's interesting in insurance is that a lot of times people are waiting on the insurer's money, right, in order to make repairs. What Captain says is, let's get you to a cost incurred basis, meaning that the money's already been spent. The repairs that you guys are looking for have already been made. And so now all they're doing is reimbursing money as opposed to funding the claim, right? And so that's how we generally think about it. And frankly, the dispute and the argument is eliminated in a lot of these claim scenarios, because now the money's already spent, the work's already done, the consumer's already whole. What's the holdup?
Yeah, that's interesting. Very fascinating. I want to talk about the genesis story, but just to understand the business model, that 5% discount is basically coming out of the contractor's total take-home pay, sort of. Is that correct?
That's exactly right. It's his insurance that he's going to be able to be paid and be able to move on to the next project and successfully perform.
Got it. Interesting. Makes sense. Cool. Well, tell me how you came up with this idea. It's very clever. I love when I get people on the show with, as I like to say, clever business models. How'd you come up with this and see this opportunity in the market?
Well, it was pretty much like every other founder story that you probably heard, which was like, I was an idiot at first. And then all of a sudden we sort of stumbled into something. I founded a company before this called WeatherCheck, which was a YC backed startup. in the damage prediction space. And in that business, we built a damage prediction model where we would notify policyholders after severe weather events of whether or not they had damage. Yes, you do. No, you don't. Our customers there were insurers who used our technology to notify policyholders. The thing that I was sort of naive about was that, again, the incentives weren't aligned. And so we did a hard pivot in that business and started trying to manage claims on behalf of policyholders. And that's really when we uncovered that there was really no financing of insurance claims in the country. So part of what was making the claims process and disaster recovery go slowly throughout the country was that there's really no money. Nobody's lending against these pieces of paper that the insurance company was generating. And that's when we sort of said, aha, okay, that's what we need to do. We need to finance insurance claims throughout the United States. And, I went out to, start the fundraising process thereafter, wound down WeatherCheck, and was really convinced that eventually we would use the IP of WeatherCheck in Captain in the future.
Not to get into too much of a nitty gritty, but did WeatherCheck, did the IP kind of get folded into Captain so that investors in WeatherCheck still have a stake in the pie, or what?
Yeah. So the way that you can think about it is that we went to the investors very quickly and said, hey, we don't see a viable path any longer to a 10x exit. Yeah. And basically they said, okay, what's your plan? And I said, well, here's what I'd like to do. I'd like to go start a fintech that does this particular thing. And my commitment to you is that you'll have the option to convert at that company's Series A, or you'll get paid back, right? And so that's exactly what we've done is sort of said, hey, you're going to get optionality at the A, and it's either going to be in the form of cash or it's going to be in the form of a stock grant into the new company. Interesting.
I guess why not just pivot WeatherCheck into this new model versus like closing one business and starting up a second one? Was there any reason?
In fintechs, you really want a clean slate, right? If you're going to go out as we did and raise significant amounts of capital, you really don't. It's prohibitive to have the history. At that point, we had already been in it, 3.5 years. Additionally, after that period of time, some of your investors start to get a little exhausted, right? With having been in the company, if the company's doesn't have significant momentum. And so we were in the middle of the pandemic, right? Everybody was fatigued and unsure. And so it just was very clear. And so we went to actually our first investor, who was still very active and was also a debt holder of ours. And he sort of said, here's what I want you to do. And so we followed his guidance.
And just to summarize what you said, it's basically, let's say you can kind of convert your equity into this new business or get paid out when we raise a Series A at this new business. I think this is really the question I'm asking is like, if you're a startup, like kind of facing a similar decision path of like, hey, do we wind this down? Like, how do you kind of make your original investors happy? Yeah.
Like many people would tell you that it's the risk that investors took.
Yeah.
It really depends on what your founder, thesis is. I have been always, as an entrepreneur, very committed to this idea that people don't lose money with me. And so in every single case of every single company I've ever created, it's always been about restoring at least the principal capital. And so that's principally why I did it the way that I did it, was that I wanted to make sure that that was always true, that nobody would ever lose. And is that going to come at dilution to me? Absolutely it is. But what it means is, and frankly, for all of these seed stage investors who came into Captain, we were very upfront about here's what we're going to do, right, at the A. And so, and then their next question is like, obviously, how much did you raise at WeatherCheck? And then you go from there. And so I think the thing that I've learned from good friend and attorney Dana Cosby was that, most of the things in business are about disclosure. Like, did you actually tell people what you were going to do and what your intentions were? And so if you're in this situation, it's really about making sure that you're being forthright, and you're really addressing any potential conflicts that you have, right? So in the instance of WeatherCheck, we did full shareholder consent as we made these decisions, right? So everybody signed, right? Now, not the safe note holders, because we had convertible notes, they're not yet converted, but all the fully converted shareholders signed off on those agreements, and that's how we knew that, like, okay, we can do this safely now because we've gotten full consent, we've gotten full authority, and we can move forward with a clear conscience, knowing that nothing is ever going to come back to bite us in the butt.
Yeah, interesting. And did I get that right? That the option they had was converting basically at that Series A or getting paid back at the Series A. So basically, when there's a new round for the new company, that's their choices. Did I get that right?
That's exactly right.
Yeah. Okay. Interesting. That's cool. All right. Well, let's talk about raising money for Captain. So, how much have you guys raised, and how many rounds?
Well, today we've raised $107.3 million. The 7.3 has all been in the form of equity, and the 100 was in the form of venture debt. And, all in really one round.
Yeah.
Financing. So still seed stage company, consistently trying to move toward the A. And, the market has certainly, thrown a hiccup in a little bit of that. But, that's sort of where we are in the overall race.
I could be wrong. It seems like your business is somewhat immune to the market. Your business is almost more dependent on natural disasters occurring, which seems like that's going to unfortunately continue, right? Like you're somewhat, maybe insulated from like the market. Am I right or no?
Oh, you're exactly right. And I wish that you would tell every investor on Sand Hill Road. So because you're right. I think, generally right now, as we sit here, in July, there's still, vacations, and between vacations and like market volatility and fear in the marketplace, that is sort of making investors squeamish and really sometimes defy a little bit of reason, which is like, hey, this is non-correlated to the market. And so it's why we believe we're bullish on it for the next decade, is because it's always going to occur. And frankly, insurance will always consistently pay when these events happen. And if it's not, then every other investment that you have is gone already anyway. So
yeah, right. Very interesting. Okay, let's talk about putting this round together. I think I read on TechCrunch announcements, NFX, GGV, and Red Swan. Talk about a couple things. What did you have a product in the market when you went out to raise money? And, how did you sort of identify the right investors? Get into the weeds a little bit, if you don't mind.
Yeah, we did not have a product in market at all. We actually started, CoVenture led the debt facility, and we actually started raising the debt first. Part of the reason we already had this insight around like the financing of insurance claims, but we weren't necessarily sure that we could raise sufficient capital to actually make the business work. So, just a total addressable market conversation is like $450 billion annually in property and casualty losses throughout the United States alone. 92 billion of that is weather-related losses. And so you're like, okay, if we're going to go into this business, we need a lot of cash. And it wasn't always clear to me. And I think it was like generally from, and for a lot of your listeners, it's probably like sometimes like in the early days of WeatherCheck, I don't think I had the courage to raise a large volume of cash in that way. It took a few years for me to get up the gusto to be able to say, and so I called up a buddy, and this was by the time that WeatherCheck was sort of like dwindling. It wasn't going the way we wanted. And I called up a buddy and said, hey, I need to raise $25 million. And he was like, okay, I'll help you, and he sort of already knew what I was calling about. And eventually it was just sort of like, um, we got into the market and started realizing that because of the pandemic and the COVID related dollars, nobody was actually willing to do a $25 million deal. They would only do $100 million deal. And so $100 million was the minimum amount that we could take at that moment, in terms of the debt financing. And so once we solidified that term sheet, then we were required to then go raise equity thereafter. Right. And part of the reason that we were able to do all of this pre-revenue is because of the credit risk of insurers. Right. When you sort of fundamentally understand what the backstop is, like what's the quality of the debt that you're or the asset that you're lending against in fintechs, that's how you can kind of think about like, well, what was the differentiator for Captain? Well, it had grade A, AAA credit risk. And so people were willing to extend credit against it and leverage against it, whether we had really shown traction or not.
Yeah, really interesting. Okay, you can give as few or as many details as you want, but like when you're raising debt first, and you'll be using that $100 million to obviously make the loans to contractors and stuff like that. Do you get $100 million in your bank account, or is it called on as you need it? Like, how's the function? And if you can talk about like terms of that, if you can, I don't know if you can, but like that'd be interesting just for other founders. I know we've had, God, I'm forgetting the name. I know we had a kind of a gig worker payout firm on here that had a similar structure where they're helping people get their paydays faster, right? And they had to raise a big round like that to have the working capital to make those loans. But yeah, what can you share?
Well, I mean, unfortunately, not much, because most of it's subject to non-disclosure. But if any of your listeners want an introduction to the folks at CoVenture, they were great to work with. And I think one of the hallmarks was that they were willing to dig in and figure out what this business actually was, right? Because they're New York-based investors. They knew the story of Hurricane Sandy, and that proved helpful. It can go a myriad of ways. The way in which we structured the deal was a scenario in which you call capital, right? And what that does is that keeps your interest expense down in terms of what you owe to the lender. And so the velocity of capital is a little bit slower, but frankly, you can call as much as you need. It's not, a scenario in which you're sort of restricted. There's some hurdles and milestones. It really is fundamentally about deployment. There is a lot of infrastructure that had to be put in place to make that possible. And so there's some great banks out there who have done a really good job of helping support us in that regard. But, that's really how it typically works. Now, there are some funds, I've being a part of the NFX portfolio, there are a number of companies who've raised significant tranches of debt finance. And, it's, as plentiful as the rainbow, different scenarios and how it's being deployed. Some people do have a full 150 million sitting there. And then others of us don't.
Yeah. Okay. Let's go to the equity round then. So how'd you, identify the right investors to go after? How'd you get in front of them? Did NFX lead the round? Why'd you choose them? So on and so forth.
Well, again, two-time founder sort of deal. Like, in the WeatherCheck days, I was sort of taking who I could get, now having the YC network to sort as a backstop, as well as having had conversations with a number of investors, access, it didn't really change the outcomes, I would say, in terms of like how you engage. So, tier 1 VC is sort of how we prioritized, and we used tier 3 VC as a test bed for pitch, right? So the reality is that we decided based on, we used them to test feedback. And so it's sort of interesting. I don't know that, and you tell me if you've heard that or not, that like people use, sub-tier VCs that aren't tier 1 to train up their pitch.
Totally. Yes. All the time. Yes.
And then you use that to go forward. And I generally think most VCs would be a little shocked to know that they're being used in that way. But It's happening a lot, and frankly, we did exactly that, and perfected the pitch on the back of smaller funds and lesser known VCs, and then from there, it was really about sort of just going down the list. We had about 50 firms that we solicited, and I think what really kicked off our fundraise was we started pitching founders first, super founders first, in that overall ecosystem. And the way we got access to them was through VC Scouts. Scouts typically have access to super founders. And that's sort of how we kicked off our process.
Okay, let's clarify some of this. So what is a super founder? And then how does the three-part question, what is a super founder? How does the scout have a connection to the super founder? And how do you identify or find scouts? Yeah.
So super founders are typically founders that have raised at least, I believe, $50 million or exited over $100 million. Okay. And, there's a lot of them out here. And how do you identify scouts?
Wait, but to be clear, super founders, these are folks not necessarily working at a venture fund you're trying to ultimately raise money from, right, but that have a connection to that venture fund, or what? What are we?
They may or may not, right? And so it's not really venture fund relationships. It's about founder experience, right? And so have they raised significant capital? Can they pick apart your pitch? So on and so forth. Early on, it was, and Brian's on his way to being a super founder, but Brian Valalunga from Doppler, who would, before I had a place in San Francisco, would let me crash at his place and would tear apart my pitch. And, Philip Berner from Keep Safe and Zuhair Belkora. Zuhair is now an advisor to Captain. And all of them wrote checks into the company. And, that was really an early signal. And all of them have investors, right? Doesn't necessarily mean that those pitches are going to go over, smashingly and with that endorsement, but it's going to continue to open doors. And so, whether you need an introduction to Sequoia or to, any number of other firms, that just becomes easier by virtue of having previous founders on your cap table.
Okay. So you're pitching them for a small check. I guess you're pitching them to get feedback and rip apart your pitch, also to write a small check so they're gonna bought in, and then it would be to lean on them for the intros next.
Yeah,
right?
and I mean it's always relative, right? Like some of the small checks were actually very big checks, but just depending on the specific founder, but really, really highly valuable. I would say that those individuals have been the most additive in terms of our sort of founder experience, and nothing against the VCs, but you're always sort of wondering if the VC is like giving you advice based on their view of the portfolio as opposed to their view of what you should really be doing. Luckily, we've been fortunate to have really, really great VC partners because most of them have been operators at some point. And so, and then the way that you identify scouts is actually relatively easy. There's platforms like Signal from NFX that help you do that. Crunchbase is a good way to also identify scouts. And generally, they're sub-associate on LinkedIn. They don't list themselves as an associate. They list themselves as something else, which I can't remember. A principal is how they typically list themselves. That's how you sort of identify like early scouts in a lot of the funds.
Great. Okay. And so they're, I guess, acting as sort of a scout, like it sounds, but a feeder into venture funds, or, kind of helping you get connected to the right partner at the fund. Or I guess, how do you reach out to scouts? What's the pitch to scouts? It's get me in there.
You really don't have to reach out to them. They're very good about, once they know that you're running a tight process in terms of your fundraise, they typically will find you It really is about, because the way in which they're incentivized is they're probably getting a portion of carry. Some of them have check writing authority. Normally they're associated with a Series A predominant fund, right? And so if you're trying to get A16Z or Sequoia or GGV or another, and then what you really want to do is, like, they're normally writing for a specific partner, right? So, in our case, Hans Tung was the partner at GGV, who came into our deal. His scout was the one who identified us. We pitched Hans, and then we were, invested in by GGV.
Who's
right?
the scout? Can you share who the scout was? Just to
A guy named, Kella Ivanye is his name, and he runs a Black founder focused program called Protege. And he and I'd known each other for a long time. I do think that, like, in that overall fundraising process, it is about building relationships such that you can consistently move forward into more intros, right? And so for me, it was always about, like, consistently building relationships over a period of years. And so even as I entered the startup ecosystem, not that I was collecting relationships, but really using that sort of relationship muscle to continually sort of build new connections. Now, if you're not a person who's interested in people, then don't bother. but because it's just not authentic, right? Like, but for me, it was like, oh, hey, I'm just generally interested in these people and what they're doing and what they're building and what's interesting right now. And there's, like, nothing cooler than, like, getting in as an early user on a new piece of tech, right? And being able to say I'm user number 12, and that was actually one of the benefits that came out of going to YC, was that, like, you get to see all this new tech that's, like, nascent, right? It's like less than a year old, and some of that stuff blows up. And so you look at a company like Deal, who's in my batch, and it's like you're an early user of Deal, right? And it's just kind of a cool experience.
Yeah, that's cool. Yeah, very cool. Any other? I don't know. It's not that this advice applies to too many people, but any other ways to sort of leverage the YC network that has been helpful? Yeah.
Yeah, I mean, well, first of all, there are a lot of founders out there now, right? Like, I mean, over 5,000 of them, I believe. And I think, the biggest thing that I would say is, like, if you can go YC style, even in your own ecosystem, wherever you are, which is to build strong relationships within whatever cohort you're in. And then once you have funding, our first investor in WeatherCheck said this. He says, "Go make the world smaller." And so, coming from Louisville, Kentucky, you're like, well, what's he mean? What he means is that in order for you to be successful in this business, you're going to need relationships that supersede this geography, right? And supersede the level of influence that even some people in your local backyard have. And so, everything about, like, like, people sort of see the headline, right? $104 million, $107 million. And what they don't really understand is that it was a progressive process of building relationships over time that really made that possible. And then a lot of other people vouching for you, as you get through it. And so, like, that's pretty much what I would say to, like, every founder who's out there trying to figure this out. It's like, you got to get social, you got to get out in front of people and start building relationships, and it'll go from there. Because, like, there's so many great ideas, right? like if you sort of put, my roommate in San Francisco is a partner or associate at a VC firm in South Park in Soma. And I sometimes sit there and listen to, like, how many calls he takes on a daily basis. And I'm like, how in the world are you even standing? Right.
Yeah, right.
Like, and it's nonstop from, 8 a.m. to 6 or 7 o'clock at night. And it's call after call. And then he spends, like, the latter portions of the night, like, I think, taking notes and, like, summarizing and following up. And you're just like, That's exhausting. I would say that, like, you've asked about like sort of fundraising tips and founder tips. One of the things during the pandemic that became increasingly obvious to me, and it was the insight from looking at Udit and seeing him like, on those calls a day, was that you started to realize that these people on the other side of the camera are also human, right? And giving them a moment, right? Yeah, they want to rush to hear your pitch and want to get started right away. But if you'll give them 30 seconds or 45 seconds to reset, right, it actually goes better for you, right? Give them a minute to settle down. They're rushing. You think about yourself, right? You're rushing from one Zoom to the next and trying to get settled, and you really don't have their focus yet. And so, like, I really found that it started to become increasingly helpful to say, it's okay, like, just take your time. Now, inadvertently, what I didn't realize was that was also putting me in control.
Yeah.
Pitch.
Yeah.
Interesting.
So you would literally, at the start of a Zoom with an investor, you would say, hey, just take your time. When you're ready to start, let's start. And then give them a minute.
Well, what I would do is I script it out and I'd say, hey, I understand that, you've had a busy day. I can't imagine how many meetings you've had so far. I'm going to give you 30 seconds to just take a breath, and then I'll start. Oh, okay. Right?
Sure.
And I built that into the pitch, right? It wasn't lost on me. It was really for them. Right. And so then you frankly just blaze through your pitch. Because the reality is that in a 30-minute call, nobody's going to get all of it. They're going to spend more time with you if they really like it. Give them the highlights, keep it moving. If you're running a tight process, you've got 10, 20 other meetings that are already lined up. They're either going to say yes or they're going to say no.
Yeah.
And
yeah.
I just never really, the beauty that the founder has in this country is that you live on in the richest country on the face of the planet. And there's money everywhere here, And so I never really ever got dejected. It really is just a function of perspective. We got a lot of no's, right? The company that raises 100 and some odd million, and we've heard that story over and over again. But I've seen emails of correspondence from other VC friends. I'm like, man, that person's so upset. But it's a function of perspective, right? What you're really saying when you respond haughtily is like, you really don't understand where you are. You don't understand what the ecosystem is like. That you should be like sort of deliberate about setting those meetings up and moving forward.
Yeah, I like it. I won't keep you too much longer, but I guess you mentioned like that Black founder program called Protege, but two-part question. Any tips specifically for maybe Black founders, resources or programs like that you recommend, if there's anything, and then just any other general tips you like to give founders about raising capital that we haven't already covered? Yeah.
Listen, I think Troy Foster at Perkins Coie, who was a former general counsel at TrueCar, gave me the best advice. And it's some of the advice that I think that I have to still tell myself, because nobody really loves fundraising. I haven't met one person who loves it. Some people like the game of it. Mm-hmm. But he said, most Black founders stop too early. Right. And so I think it's like understanding to keep going. Right. Even though you've had the no's and you've had this and you've had that, just keep going. Right. Keep pushing, keep taking meetings, keep going. Eventually you'll find a fund who says, you know what, I love it. The other thing is there's two parts. It's like, take it seriously. Right. It's worth saying that like it is a performance. Mm-hmm. In the Black community, we're a community of a lot of entertainers and athletes, right? Michael Eric Dyson would call us performative, right? And so if that's the case, then you need to take a cue from Serena Williams and Mike Tyson and Floyd Mayweather and all of these greats, LeBron James, and treat it like it's a performance, right? You should not come on camera and not be ready. You should wow every single moment, right? And so In a lot of ways, that means high definition camera, like being ready, having great audio, all of those different sort of things that while they aren't going to be the thing that makes the decision, it will be the thing that'll be the difference, right? When you're trying to decide between, well, should I fund this founder or should I fund that one? Well, man, his audio was, man, did you see that room? Like, that was memorable. He took it seriously. She took it seriously, as opposed to, a laptop. And now, if you're that brilliant, some people can pull it off. I happen to not be one of those individuals who can be like, oh, I just, did quantum fusion in my sleep. And so that's how I generally think about those two bits of advice. It's a performance and you should behave that way. And number two, don't stop, keep going.
And for people just listening, not watching, Demetrius has a cool backdrop. It's like kind of a burgundy color pattern with Captain as a, is that just a virtual background in Zoom or what are we?
It's just a virtual background. And I can't take credit for this because somebody in my office now requires there to be virtual backgrounds up on everybody's screen. So it's just serendipity at this point.
But for people not watching, it's got the company name, the URL, the little tagline. It's nice looking. Yeah. So got it. Good stuff. All right. Well, I'll let you go. Anything we haven't covered, any last tips, or if people want to learn more about what you've got going on, where should they find you?
Listen, we are working in true Russell Brunson fashion to, build out our funnels. And so they can find us on Facebook. Captain HQ is what they can look up. And, and then, of course, me on Instagram, drgray101. And that's the story that we're sticking with right now.
Interesting. You focus on Instagram more than Twitter or LinkedIn or other places?
Well, truthfully, it's the one that I actually like.
Yeah.
I enjoy being on Instagram more than I enjoy some of the other platforms. And so, mastering one at a time. The company is heavily focused on Facebook. And so, yeah.
Cool. Last question, did you interact with or have any investor interactions on Instagram? Or is that just totally off the path?
We have inbound sometimes from Instagram. We have inbound from like a lot of social platforms typically. But normally it sort of eventually makes its way to email and follows that same process. Part of the reason is because of like just the ability to check open rates and, all of those different sort of things. The other piece is like putting people in a backlog or parking lot for investment. You'll get inbound and just putting them over there. And I found that there's no downside risk of like, a few weeks or months later saying, hey, sorry I didn't reply to you way back when I was raising. It was crazy. The round closed. Thanks for your interest. Now we're raising again, right? It seems to work.
Yeah, no, totally agree with that. And not to make this a plug for our product, but like we have a CRM for putting investors in, then you can add them to your investor update list. Even if, they said no, or you're too early, or they came in inbound, good to keep those other pipelines kind of up to date, because you never know when they could either lead to an intro or come in a later round. So,
Exactly right.
Excellent. All right, Demetrius, thank you so much. CaptainHQ.com, pretty cool stuff. Enjoy the rest of your week there in Louisville.
Thanks a million. Peace.
Over now.